This week was a bit of tug of war between inflation and the jobs numbers, and that back and forth is exactly why mortgage rates didn't really make a big move, although they are a touch better than last week. But I want to start with inflation because that was the better news. The CPI report that came in was pretty solid. Both the headline inflation as well as the core inflation were both a little below expectations. Shelter costs, which make up a huge chunk of inflation, continued to cool, even though they're still overstated compared to the real-time rent numbers that we're seeing elsewhere. But if shelter actually were caught up, then core inflation would likely already be at the Fed's target, maybe even lower. Airline fares did jump, and that kind of pushed the numbers a little higher than they otherwise would have been. But that won't necessarily continue, although I guess remains to be seen. We are also seeing signs that the inflation impact from tariffs does seem to have mostly worked its way through the system. And so now we can kind of talk about the frustration this week, which came from the jobs number. The BLS jobs report came in much stronger than expectations, showing solid job growth, lower unemployment, and even higher wages. But on the surface, that is bad for mortgage rates because it does reduce kind of urgency for the Fed to cut. But here's where it gets a little messy. Other labor reports that we've seen tell a really different story. ADP showed really weak private sector hiring. Revelio showed job losses. And the Challenger Job Cuts report shows, companies are continuing to make cuts. And the raw figures that do go into the BLS report actually showed millions of job losses before they made these seasonal adjustments and, flipped it into job gains. And even the BLS admitted weather issues. It might have made January's numbers harder to collect, which makes the report even less reliable than it already has been. And this is not their first excuse for being inaccurate. Jobless claims also moved up a bit, but they still understate reality because people who jump into gig work or run out of benefits don't show up in the initial and continuing claims figures. And we did also see some higher signs of consumer stress. More people are actually falling behind on credit cards and auto loans than at any point since the financial crisis, at least with 90-plus day lates. And spending, it hasn't dropped yet, but it does increasingly look like people's continued spending has been on credit. Next week, we're going to get a lot of news, everything from jobless claims and inflation updates to GDP. And if inflation continues to cool and labor market numbers start to confirm the weakness that we've seen elsewhere, rates could finally get some real traction lower. But I'll see you next Friday.